And so with that, now I'm going to go ahead and introduce our panelist. So we're really excited to have Lindsay Clark with us again. She's the Chief Borrower Advocate at Savvy and a familiar face to many of you. She's been on several times talking about what's going on with student loans. And she always does a really amazing job breaking down student loan info that's tough to track. And we're really glad to have her back today to help us make sense of all the recent changes and what they actually mean for borrowers. And I think she even had to update her PowerPoint like yesterday um, of changes that just happened. So with that, I'm going to go ahead and hand it over to Lindsay, who can tell you a little bit more, but we're really glad that she's here with us today because she just uh, made it through a tornado. So go ahead, Lindsay.
Thank you so much, Ellie. And yes, apologies that I am not on camera. I am down in Alabama at the moment where there were 2 tornado warnings and shelters in place that just came through within the last couple of hours. So I thought I may have to send in the reserves to do this today, but luckily they've passed. So I am here with you. And it's always a pleasure to join Ellie, Bruce, and Ebony, and everyone at NHRC. I think we've been doing these since 2019 through all of the policy changes around student loans. So this is going to be a long one. Buckle up and settle in. But all of this information will be shared back with you all. And I'm here to be as much of a resource and helping hand as I can over the next hour or so. So we will dive right in. So just a few housekeeping notes. I think these were already mentioned. Obviously, the session is being recorded. That said, if you do have any questions throughout the presentation, please feel free, I think, put those in the chat, Ellie, if that sounds good, instead of the Q&A. Ellie will be manning the chat for me, and we'll be taking some periodic pauses to hopefully answer some of those questions out loud. We'll do our best. And then I think if you need to enable closed captioning or live transcription, Ellie or Ebony might have posted a link in the chat on how to do that.
So questions in the Q&A box, please, not in the
Okay.
chat. We don't want to lose track of them.
Perfect. Okay, so questions in the Q&A. All right. Okay, so a quick look at the agenda that we're going to cover here today. I'm first going to do some brief introductions of myself and who we are here at Savvy and our relationship with NHRC. And then we're going to dive right in. So I'm going to start with sort of a student loans 101, an overview of some of the basic things that everyone should know about their federal student loans. Things like the different types of federal student loans, what are student loan servicers and the role that they play for a student loan borrower. Then we're going to talk about income-driven repayment plans, or IDR. These are a powerful way to help lower your monthly payment on your student loans. And there's a lot that's been going on with these IDR plans. So we're going to cover generally how they work and how borrowers are able to see that monthly savings and ultimately get those loans forgiven after a certain period of time. We're also going to talk about one of the biggest and longest standing forgiveness programs out there called Public Service Loan Forgiveness, or PSLF. This was written into law back in 2007 under the Bush administration. And it is something that many of you on this call here today, if you do have student loan debt, would likely be eligible for based on the fact that you work for a qualifying 501c3 nonprofit employer or government agency. So we'll go into all the details on that program in just a bit as well. And then we'll wrap up that section with policy updates. Now, over the last couple of years, sometimes these slides have been 1 or 2 slides long. And at this point now, we've got at least, I think, maybe 6 or 7, just given all of the changes and things that we are sort of monitoring when it comes to student loans these days. So I'm basically going to try to capture the most important things that you all should know and be aware of at this point in time. And I say at this point in time because a week or 2 weeks from now, or even tomorrow, things could change. But I'm really going to try to simplify and make it digestible in a way that is understandable to you, and that you can hopefully communicate to others that you might be speaking to around their student loan debt. And then we'll wrap everything up after we've gone through all of that information by showing you how to get started with Savvy, what this resource and tool can do for you, your employees, your clients, members of your housing community who have student loans. I'm going to show you how this tool works and how it helps borrowers not only understand their student loans better, but ultimately reach the best outcome possible, whatever their situation may be. So with that said, again, my name is Lindsay Clark. I am the Chief Borrower Advocate and Director of External Affairs here at Savvy. I have been at Savvy since it was founded back in 2017. I'm a student loan borrower myself. I have a little over $200,000 in student loan debt between undergrad and graduate school. I say that for a couple of reasons. One, if it makes any of you feel better about your own situations, then mission accomplished right off the bat. But two, because being a borrower impacts how I communicate about these topics. My goal here today is not to speak at you. It is to communicate around these really complicated things in a way that finally might make sense. And so I think having student loans myself, I wasn't always an expert. I spent over a decade not knowing what income-driven repayment plans were, going into forbearance and out of forbearance, and seeing my loan balance just continue to increase. And so knowing all of this informs how I communicate around these topics. I also know that there's a lot of stigma and sometimes shame around student loan debt. And I want this to feel like a very safe and open space where all of you and any of you who do have student loans can ask your questions freely. And I'll be speaking about my own student loan experience and using myself as an example, hopefully to help reduce any of those anxieties that anyone might have about this topic. Now, I work for a company called Savvy. Savvy is a social impact technology startup based in Washington, D.C., and we were founded by student loan experts and advocates who had been fighting on behalf of borrowers for more than a decade. And in 2017, this was actually the first year that borrowers could start applying for a program called Public Service Loan Forgiveness, which we're going to talk about a little bit later on. All to say that hundreds of thousands of borrowers applied that year and 99% were rejected. And again, we'll go into the reasons why in just a bit, but we saw this happen and decided to do something about it. A lot of it boiled down to technicalities, administrative burdens that borrowers were just not able to overcome on their own. So we decided to create a technology and human platform to help borrowers like you and like me not only better understand our student loan debt, but to navigate successfully from start to finish around some of these really complicated government programs. But along the way, our goal is to make the experience of being a student loan borrower a better one, because I think we can all agree it's not great. So we try to do that by identifying as much additional savings as possible on a month-to-month basis through things like income-driven repayment plans. At Savvy, we like to think that borrowers, not their student loan debt, are our top priority. There are a lot of companies, entities in this space that focus on servicing the debt. Their priority and their sole concern is collecting on that debt, making money off of that debt. And our approach is far different. We realized that borrowers didn't have anyone looking out for them. And so our top priority is borrowers and ensuring that regardless of what their situation may be, each borrower is able to achieve the best outcome possible, whatever that may be. And that brings us to why we're here today, because we have had the pleasure of working with NHRC, I think going back to 2019 or 2020, to provide NHRC community members with Savvy as an exclusive student loan benefit. So not just anyone can access Savvy. We provide our tool and our platform through these partnerships with employers, membership organizations, financial institutions, unions, you name it. to be able to serve their broader communities. We work with NEA, the biggest teachers union, AARP, MetLife, TIAA. We have over 500 plus employer partners across higher education and healthcare. And we really take pride in the fact that these entities have trusted us with helping their employees and their communities overcome their student loan debt. And Savvy is available to not just you, but your colleagues, your family members, immediate family members, and all members of your housing community. So our goal here today is to deliver this information to you. But when it comes to accessing Savvy and being able to spread that benefit around, we want to help as many people as possible. So we are so excited to be presenting yet again on the Leaders in Housing Counseling webinar with NHRC. And together, our goal has always been to help everyone achieve the best outcome possible for their loans. Now, I just wanted to take a quick second, and Bruce does not know that this is coming, but from everyone here at Savvy, we wanted to just say a huge congratulations to Bruce for his Lifetime Achievement Award from the Affordable Housing Centers of Pennsylvania. We were made aware of this earlier this month. We've had the pleasure of working with Bruce since the very beginning of this relationship, and his dedication to this topic and to being able to provide the NHRC community with resources to help their members overcome their student loan debt is something that is inspirational to all of us. So Bruce, from everyone at Team Savvy, we wanted to say congratulations. And Ellie has been there fearlessly every step of the way. This is one of our longest standing partnerships. So it's always a joy to be able to work with Bruce and Ellie again. So Bruce, again, congratulations on all of your achievements from everyone here at Savvy. All right, with that said, we are going to transition into student loan basics, or what I like to call Student Loans 101. All right, so first up, let's talk about student loan servicers. So there are examples of these servicers on your screen right here: Ed Financial, Aidvantage, Nelnet, CRI, Mohila. These are companies that are contracted by the Department of Education in the repayment and management of your student loan. So when you have federal student loans and you graduate and you go into repayment, you are assigned to one of these servicers. So the loans itself, those federal loans, are issued by the Department of Education, but when it comes to collecting on those loans, that collection is assigned to these companies. And you don't have any say or control over which servicer you are assigned to, right? And this is the sort of the account that you will be given access to, and you'll manage on a month-to-month basis, where you'll pay your monthly bill, you'll set up your auto debit, you'll get your monthly statement, right? So most of your day-to-day management of your student loans is done through these servicing companies and websites, but they're contracted through the federal government, right? Just to be clear. Now, it is completely normal for your federal loans to move from one servicer to another over the lifetime of that loan. My loans have been in repayment since 2011, and I've had 3 different servicers. The reason why these changes happen, these are contracted companies. Sometimes those contracts end and are not renewed. And so borrowers who may have been serviced by Navient, for example, when Navient's contract ended, those borrowers were all moved over to Aidvantage, right? So again, not in the borrower's control, but it's very easy for a borrower to potentially miss an email or a notification that their loans have now moved to a new servicer. So it's really important to know what servicer you have if you don't already. Now, where can you find out this information? Well, there's one place and one place only. And that is, I'm going to type this link in the chat right here, studentaid.gov. Now, studentaid.gov is the official website of the Department of Education. So anyone who has ever taken out federal student loans or received federal grants has gone through studentaid.gov. They've created their FSA, or Federal Student Aid ID, right? So when you went through the FAFSA process to get those loans to begin with. And so by logging in with that FSA ID, you will be brought to your dashboard of any and all federal loans and grants. And right on that dashboard, it will show you what your servicer is. So if you're just not sure, you want to double check, again, you can see all of that from studentaid.gov. Now, one thing I just want to clarify is that Savvy, our student loan benefit company, is not a servicer. So by working with Savvy, your loans would never move to Savvy. You would never start making your monthly payments to Savvy. You can kind of think of us more like an intermediary or an advocate on your behalf. So if borrowers are on one side and servicers are on the other, Savvy's sort of right in the middle. And our goal is to reduce the friction that many borrowers experience with their servicers, whether it's they attempt to call to get a question answered and are on hold for 3+ hours and can't get a hold of anyone, or they never feel like they're getting the right information. Whether it's they submit an application and hear nothing back, or it's rejected and they don't know why, right? We are that intermediary to ensure that what the borrower is submitting to the servicer and what the servicer is responding with and reviewing and then giving back to the borrower is accurate. We hold those servicers accountable, but we also provide borrowers with peace of mind every step of the way. So we submit those applications on your behalf, we monitor them, and ensure they achieve the desired outcome. All right, so that's just a general overview of how these servicers operate. Now let's move into talking about the different types of federal student loans. And I will say this is a really important one because the type of federal student loan you have is going to determine your eligibility for certain repayment and forgiveness programs. And there may be corrective action you need to take to make your loans eligible for those programs. So many people think of student loans as, well, federal loans or private loans. But when it comes to federal loans, there are different types of federal loans, generally based on when you took out that loan or if you were a parent or the student taking out that loan. So I'm going to walk you through the different types of federal student loans in the green columns here, and then I'm going to touch on private loans at the very end. So let's start at the furthest left-hand side of your screen with direct loans. So the direct loan program began around 2010 under the Obama administration. And if you have a student loan that was dispersed to you from 2010 to present day, there is a 99.9% chance that it is a direct loan. The easiest way to tell if it's a direct loan is it will literally say the word direct in that loan title, or DL, which stands for direct loan. Examples include direct subsidized, direct unsubsidized, and direct consolidation loans. Again, if it has that word direct in it, that means it's a direct loan. Now, the great things about direct loans is that they are eligible for pretty much all of the income-driven repayment and public service loan forgiveness program that we're going to talk about here today. So if you have direct loans, you are good to go. Now let's move on to these FFEL loans here in red, FFEL loans, which stands for Federal Family Education Loans. Now, this was simply the federal loan program in existence prior to direct loans. So if you had a federal loan dispersed before 2010, there's a good chance it could be one of these FFEL loans. The easiest way to tell if it's a FFEL loan is it will literally say FFEL or FFELP. That P just stands for program, but that's a FFEL loan in that loan title. Okay. So examples include FFEL subsidized, FFEL unsubsidized, and even FFEL consolidation. Now, here's the thing about these FFEL loans. They are only eligible for one type of income-driven repayment plan. And in order to be eligible for public service loan forgiveness, they need to go through a corrective action, what I'm going to call consolidation. FFEL loans need to be consolidated in order to qualify for all of the different types of income-driven repayment, and most importantly, in order to qualify for public service loan forgiveness. Now, when I say consolidation, I'm not referring to refinancing. I'm referring to consolidation as the federal process by which you are consolidating one or several loans into what's called a direct consolidation loan. The primary reason to consolidate a loan is because you have one of these older FFEL loan types that by consolidating it, you are therefore making it eligible for the program. So a FFEL loan in its current form is not eligible for public service loan forgiveness. Upon consolidation, it becomes eligible. Okay. So again, that's one of those loan types where if you have that loan, you will want to take that corrective action of consolidating sooner rather than later. Now let's move on to plus loans. So plus loans come in two varieties, parent plus loan and grad plus loan. So let's start with parent plus loans. Many people think the student debt crisis is a young person's problem or a millennial issue, when in fact, the fastest growing demographic of student loan borrowers is actually ages 50 plus. It's parents taking out loans for their kids. And that's exactly what a parent plus loan is. It's a loan taken out by a parent on behalf of a child, but in the parent's name. Now, when it comes to these parent plus loans, they essentially might as well be the student debt of the parent. They cannot be transferred to the child. They are in that parent's name in perpetuity. Okay. Now they are in red here, just like those FFEL loans, because parent plus loans also need to be consolidated first before they can become eligible for income-driven repayment and public service loan forgiveness. So they can become eligible for those programs, but again, consolidation is required first to turn them into a direct consolidation loan that would then be eligible. All right, now let's move to grad plus loans. So grad plus loans, as the name might imply, are loans given to graduate or professional students. And the good news here is that they are eligible as is. They require no consolidation. They can be eligible for both income-driven repayment and public service loan forgiveness. So at this point, if you are already starting to get a little overwhelmed and confused by the acronyms and all the technicalities, you'd be absolutely right. It just goes to show you how overly complicated this system can be. But the big takeaway here is this: knowing your loan type is important, because if it is a loan type like a FFEL loan or a parent plus loan that would require that consolidation, right, that corrective action in order to become eligible, you want to do that as soon as possible. All right, now let's touch on private loans. So of all the student debt out there, right, about 1.7 trillion, 90% of it is federal. So only about 10% are private loans. But many borrowers end up having to take out private loans after they've exhausted their federal options, myself included. So many borrowers have both federal and private loans. Now, when it comes to private loans, these are obviously non-federal loans that are made or issued by a commercial lender, such as a bank, credit union, state agency, or maybe even your school or university. So some examples include Wells Fargo, SoFi, Discover, Chase, things like that. Now, when it comes to these private loans, unfortunately, they are not eligible for any federal repayment, forgiveness, or relief programs out there. And there's no corrective action like a consolidation that you can take to make them eligible. Once they are private in perpetuity. With that said, if you do have private loans, the best and my sort of best recommendation for navigating and dealing with those, given they aren't eligible for those federal programs, is going to be reaching out to your individual lender. Because there's no overarching federal system by which these lenders must abide, each lender is going to offer its own different types of repayment plans and potential forbearances and things like that. So again, the source of that information and what options you have available to you when it comes to your monthly payment are going to be directly with that lender. One of the great things about Savvy is that we do what we call three-way calls. You, the borrower, we at Savvy, and your servicer. We initiate the call and basically lead it with you to be able to ask the questions and help get the right information we need and or take the steps that we need to take with your servicer while you're there to be able to ensure that you get the best outcome possible. Because I know many borrowers will be told information and not know what they're being told is incorrect. So it's almost like you have sort of an advocate right there on the line with you to make sure that everything you're being told and we're exploring all of the options that are potentially available to you. And we do those oftentimes with those private servicers because, again, we need to explore what options they might provide. All right. Okay, now we are going to move on to talk about income-driven repayment plans, or IDR. All right, so let me back up a second and just give some basic context as to how repayment works when it comes to federal student loans. So when you graduate, right, you have your 6-month grace period and then you start in repayment. When you get that first bill from your servicer, let's say it's Mohila, the monthly payment amount that they send you, right, uh, that payment amount is a monthly payment on what's called the standard plan. This is what every single federal student loan borrower is automatically put into when going into repayment for the first time after graduating. Now, the standard repayment plan estimates your monthly payment on two things: how much student loan debt you have, so that balance, and a payoff horizon of 10 years. So I'll use myself as an example. Someone with over $200,000 in student loan debt with a 10-year payoff horizon on the standard plan, my monthly payment is somewhere close to around $2,000. It's not affordable, at least for me, by no means. And many borrowers, especially as in the recent decade, student loan balances steadily increased, many borrowers simply were unable to afford a monthly payment on that standard plan, again, because it was being calculated on their student debt balance, how much student debt they had. So over the years, the federal government and administrations have introduced sort of variations of what are called income-driven repayment plans. And with these plans, instead of basing your monthly payment on how much student debt you have, these plans base your monthly payment on two very different things: your income and your family size. So you could have $500,000 in student loan debt. It wouldn't matter if you were making less than $25,000 a year, you could qualify for as low as a $0 monthly payment on an income-driven repayment plan. So again, does not matter on those plans how much student loan debt you have. It's solely looking at your income and your family size. They generally cap monthly payments at anywhere between 10 to 20% of your discretionary income, depending on the plan. So what is discretionary income? Well, part of your income is set aside to cover the cost of living. That leftover amount is called discretionary income, and this is what your payment is based on. If you were looking at your tax return, it would be your AGI, or adjusted gross income. So I'll give you an example. Let's say you file your taxes as single with no dependents and an income of around $52,000 a year. On an average income-driven repayment plan, that's going to come out to around $160 a month. And it's sort of a sliding scale from there, right? Higher your income, the higher your monthly payment. Lower the income, lower the monthly payment. And if your income is in the range between $0 and about $30,000 a year, you are likely to qualify for as low as a $0 monthly payment on that plan. Now, for every child dependent that you have, that typically lowers your monthly payment by about $50 per child, $50 per child, including unborn child dependents. Okay, so if you are pregnant, you can count that when submitting your application. Now, I realize I just skipped over this part, but let me back up and first just explain the different types of income-driven repayment plans. So you can kind of think of income-driven repayment, or IDR, as the umbrella descriptor term here, right? And then there were four. We're going to say there are three primary income-driven repayment plans in existence that you can enroll in right now. PAY, which stands for pay as you earn, IBR, which stands for income-based repayment, and ICR, which stands for income contingent repayment. Now, why do they have all these different types? Well, over the years, again, under different administrations, have introduced their own flavors into the income-driven repayment plan. And so qualifications for one versus the other come down to a multitude of things. Some of them include your disbursement date and things like that. I'm not going to go into the details on what the differences between the qualifications are here today, but all to say that one of the values of the Savvy tool is that we intake information from you and we're able to provide you with a very accurate estimate of exactly which income-driven repayment plans you'd qualify for and what that monthly payment would look like. Now, I say there are three primary income-driven repayment plans. There were four, but the fourth one, this SAVE plan that came into being under the Biden administration, has been put on hold after injunctions were put through in the courts. There were lawsuits that got filed last year that basically prohibited that plan from moving forward. Now, about 8 million people had enrolled in the SAVE plan at that point and are now on a forbearance. And we'll talk about the implications of that in the policy section in just a bit. But as of right now, plans that you are able to actually enroll in are Pay, IBR, and ICR. You cannot enroll in SAVE at the moment. All right. Now, again, low-income borrowers could be approved for as low as a $0 monthly payment. Now, how do you enroll in these plans? Well, there is an application. And with that application, a borrower needs to attach supporting documentation attesting to their income. This can either come in the form of their most recent tax return, or, and this is really important because I would say 99% of borrowers and people don't know this, you can use your pay stub. Why would you want to use a pay stub over your tax return? Well, if you are an hourly worker, meaning maybe from one week to the next, your wages are fluctuating heavily, you can use a pay stub from the last 90 days, whichever one you want, and submit that with your application. Now, if I'm an hourly worker, I'm going to try to find a pay stub that maybe from my lowest hours that week, right? Because what happens is the Department of Education takes that amount that's represented on that biweekly pay stub and extrapolates it out over the year as your income. Okay. So by using your pay stub, you were able to more effectively, I would say, optimize your monthly payment or maximize potential savings based on those fluctuations in income by isolating a period of lower monthly payment or income that you were receiving at that time. So again, most people only think that you can attach a tax return and that's the way it has to go. But no, you can also provide a pay stub. And I recommend borrowers doing that, especially for those who are hourly and do have severe fluctuations in their income from one week to the next, or maybe overtime and things like that. If you are unemployed and have no income, you do not need to attach any income documentation at all. This gets attached to the application and it gets submitted to your servicer. Let's say Mohila. Mohila reviews that application and says, okay, Lindsay, you're on the pay plan and your payment amount is $160 a month. And it locks that payment amount in for 12 months. 12 months comes and goes, and you have what's called a recertification deadline. And by that deadline, in order to maintain yourself in that pay plan, you need to resubmit another application with updated supporting documentation attesting to your income, and your servicer will do the exact same thing again. They'll say, okay, Lindsay, now actually your payment's gone up to $180 a month based on an increase in your income. So, the implication being from year to year, based on any fluctuations, increases or decreases, right, to your income, your payment amount could change, could go up or it could go down, right? Or if your family size increases, that could cause that payment amount to also decrease for that next year, right? Now, one last thing about these income-driven repayment plans is that borrowers enrolled in them are eligible to have the remaining balance forgiven after 20 to 25 years of payments, depending upon the plan. So because these plans forgive remaining balances, the sort of goal here is the less you pay, the more you get forgiven, right? So for borrowers who are trying to take advantage of that forgiveness, you really want to minimize your monthly payment to maximize your forgiveness. There's no benefit to you to try to pay more than you absolutely need to, because again, you're trying to set yourself up to ultimately have the remainder of that balance forgiven. Now that forgiveness under income-driven repayment plans is tax-free through the end of this year. And unless that gets extended by Congress after this year, it would be considered taxable income, any forgiveness that comes through from income-driven repayment forgiveness. Now, how long you pay for depends on a few factors, like the plan and your loan type. So you can see here between pay, IBR, and ICR, there are different sort of qualifications and breakdowns. But generally it's either 20 or 25 years. And there's no application needed to receive that forgiveness. It's done automatically after you've been paying and enrolled for the required amount of time. Okay. Ellie, do you think we should take some questions if they're related to maybe something on income-driven repayment or what I've touched on so far? Or do you think we're good to keep going through PSLF and then take a pause?
Let's ask a couple of questions. So there's
Sure.
one that went in. There's one that went into the chat that I was just about to say to the person, put it in the Q&A so I don't lose track. But so let me go ahead and ask that one. As of 5/22/25, the servicers have a backlog of more than 2 million income-driven repayment applications. Have you heard a different number on this backlog or time frames?
So I've heard the same number. This was actually the number that was released by the Department of Education as part of a lawsuit that was filed against them. In order for that lawsuit to be dropped, the department had to agree to publish certain data around their application processing. And that is exactly what so that number is accurate. And it reflects what we have been seeing sort of on the ground, at least over the last 6 months. For when Trump came into office, they basically paused all processing on applications. They actually even took down the online application from studentaid.gov for income-driven repayment. So borrowers weren't even able to enroll for a few months. And if you were submitting a paper application, again, everything was put to a halt. So that lasted pretty much upwards up until the last couple of weeks. As of May 10th, all servicers have resumed processing those applications. So we are seeing tremendous delays when it comes to income-driven repayment processing, public service loan forgiveness across the board. Because again, they've got a huge backlog that they've got to work through. So when submitting an application to enroll in an income-driven plan, where it might have taken, 4 years ago, maybe a couple of weeks, less than that, and you would have been able to get enrolled and start making that payment the following month. Now I'd say you can expect to wait definitely upwards of 1 to 2 months while that application processes. However, while you are waiting and after that application has been submitted, they should be putting you on an automatic forbearance, an administrative forbearance, while that processing takes place, where you're not responsible for payments. So long-winded way of saying, yes, that's exactly what we're seeing. It's causing a lot of disruption and uncertainty for borrowers who are submitting applications, and months are going by and they have no idea what's going to happen. And so we're actively monitoring that. But again, just being prepared for delays in processing is important.
Okay, there's so many questions. One person is just saying that they had hoped that Savvy would be able to access their student loan information, but apparently you are unable to see any of the information or the PSLF. And they've tried to get in touch with the servicer Mohila, but hasn't been able to speak to a representative. So this person isn't sure where they stand, and they had an IDR with the SAVE plan, but it was put in forbearance, so now they're in limbo. And there's a few people asking about, what recommendations if I'm already on SAVE, or I have clients who are on SAVE.
Yeah. So I'll get to that in the policy section, because I'm going to talk about
Okay.
what's happening with SAVE and those recommendations. But for someone who, trying to get access to Mohila, and by that I mean trying to get a hold of a human and get answers is hopeless. I would consider myself a student loan expert. I have Mohila. A couple of months ago, I was on an auto debit, so it was coming out automatically each month. A couple of months ago, they auto debited my account for the normal amount and then returned that amount to my account. Unbeknownst to me at the time. And then a few weeks went by and I logged into my account and they were marking me as past due. The only way to correct that is by trying to call Mohila. And it took me over a week and about a dozen or more attempts of waiting on hold as long as I could to get a hold of someone to correct that issue and figure out what was going on. So this is something that's been happening across the board with servicers, right? If you're not able to just get the customer support to be able to figure out where you are, what you need to do, et cetera. With Savvy, and I'm going to show you this later on, we actually you're able to sync your student loan information and upload your what's called NSLDS student loan data file. And that, without giving us access to your actual account, that allows us to see exactly what's going on, how far along you are on payments, what repayment plan you might have been in, what repayment plan you should be in, all of that stuff we are then able to present to you in your dashboard and plan results. So we can help you determine where you are, and I'll show you exactly how that works in just a bit.
All right, and I'd say go ahead.
Okay, all right, great. So now we are going to talk about public service loan forgiveness, or PSLF. So PSLF is essentially full forgiveness on the remainder of your loan balance, whatever that may be. It could be $5,000, it could be $500,000. It doesn't matter. Tax-free, so there are no federal tax implications here in perpetuity, unlike the income-driven repayment forgiveness that I was just referring to, after you have made 120 qualifying payments. Now, if you could see me on screen right now, I'm saying qualifying payments in major air quotes because the devil's in the details as to what constitutes a qualifying payment. It really comes down to satisfying these three things that you see on your screen right here simultaneously. Number one, you have to work for a qualifying employer. This is any government organization at any level, federal, state, local, or tribal, or any non-for-profit 501c3. The only stipulation is you have to work a minimum of 30 hours or more per week. However, you can combine multiple or part-time employment to qualify, so long as all of the employers are eligible. So let's say you work part-time at one 501c3 and part-time at another 501c3. So long as combined, you're working on average 30 hours or more a week. So long as the employers, as C3s, are eligible, you can qualify. So you don't need to be full-time at one employer to qualify. Now, one of the other things about your employment is that this program is retroactive, going back to October 2007. Why October 2007? Well, that's when it was written into law. So any qualifying employment that you've had from October 2007 to present day, doesn't matter how many employers you've had, anything from October 2007 to present day is fair game. Fortunately, for the purposes of this program, anything before October 2007 is irrelevant. All right, so the clock starts October 2007. Okay. All right, so that's the employment. Now, number two, you have to have a qualifying federal loan. The only types of federal loans that qualify are direct federal loans, okay? If you have a non-direct federal loan, like a FFEL loan or a Parent Plus loan, right, that we talked about earlier, you need to consolidate those loans, okay, into a direct consolidation loan to qualify. So that's why I really emphasized those loan types earlier in the presentation, because they impact your eligibility for a program like public service loan forgiveness. Again, you can become eligible. It's not like, you're out of luck. You just need to take that step of consolidating. And that's absolutely something that Savvy can not only help you identify if you need to do, but we also help you submit that consolidation application. So that's number two, qualifying federal loans. And then number three, you have to be paying those federal loans on a qualifying repayment plan. The only types of qualifying repayment plans are income-driven repayment plans. It could be any one of those three that I mentioned. Doesn't matter which, just has to be one. And you need to make that payment on time and for the full monthly amount. So you basically need to satisfy all three of these things simultaneously. Hold on one second here. I might be missing a slide. Nope. Okay. You need to satisfy all three of these things simultaneously and need to make 120 of those qualifying payments. Now, let me first clear up a few common misconceptions about these 120 qualifying payments. First of all, they do not need to be made consecutively. You just need to make 120 total cumulative qualifying payments. So let's say you worked for a 501c3 for 2 years and you accumulated 24 qualifying payments. And then you left. Maybe you went to work in the private sector or you took time off. Doesn't matter. Nothing happens to those credits. They simply pause. And if you were to ever resume your eligibility by working for a qualifying employer, doesn't have to be the same one. It can be any qualifying employer. You can resume accumulating those credits towards the 120. All right. So again, does not have to be 120 consecutive payments. You just need to get 120 total. And they can come from any number of employers as long as they are qualifying. Most borrowers that we have or we assist on average have 3 to 4 different employers over the course of that 10 plus year span of their career that are contributing as qualifying employment towards public service loan forgiveness. Now, with that said, you can only receive one qualifying payment credit per one payment per one calendar month, meaning you can't double up on payments in a month and get double the amount of credits, or you can't make a big lump sum payment and get more credits than you normally would. Easiest way to think about it is this. In any given calendar year of 12 months, the maximum amount of PSLF qualifying credits that you can receive is 12, right? One per month. So if you have to get to 120 total, you can only get a max of 12 per year. You are all very smart and can do the math there. That's 10 years minimum, right? Before you'd be able to achieve forgiveness under this program. And that's why many people refer to it as a 10-year program. However, I discourage you from thinking about it that way because this program does not determine your eligibility based on time served. I've worked with countless borrowers who have been in public service working for a qualifying employer for 10 plus years, but they are not eligible for public service loan forgiveness until they've satisfied these 3 things and achieved those 120 qualifying payments. All right. So if you've been working for a qualifying employer for 8 years, right, and you take out loans, student loans on that 8th year, right, and start making payments the following, your clock will start when those loans go into repayment. Those 8 years that you were working for the qualifying employer and didn't have federal loans in repayment don't count, right? So you need all 3 of these things to be true in order to get those qualifying payments.
There are a lot of questions about that
Okay,
slide. So,
I'm
and
sure there are. I'm opening up the Q&A here, so I'll try to
yeah, I mean, they're
yeah.
like the questions are around, so no grad loans, what if my payment is 0
Yep.
and only income debt, only the IDR payment?
Okay, yep. So no, grad loans count for PSLF. Absolutely. Grad loans are direct loans. They count for public service loan forgiveness. So they're the only loan types that are not eligible for public service loan forgiveness in their current form is a FFEL loan or a Parent Plus loan. But after consolidation, they're eligible. Okay. So really all those loan types will be eligible, everything except for federal loans. When it comes to payment amount on an income-driven repayment plan, $0 payments absolutely count. That's actually the dream. If you are able to qualify for a $0 monthly payment, and each one of those $0 payments is actually accumulating a credit towards PSLF, right? As far as the time during the COVID payment pause from March of 2020 through what was October of 2023, 43 months in total, right? When borrowers had their payments automatically paused, 0 interest. If you were working for a qualifying employer during that time, all of those 43 months count as qualifying payment credits, even though you didn't have to make a payment. So that's basically putting you a third of the way closer to full forgiveness without having to pay a dime. That was a huge win for public service loan forgiveness under the Biden administration. The borrower, I'll get to this in a second on the borrower having to provide proof of income to the employer, but absolutely does not. Your enrollment in an income-driven repayment plan and that proof of income, et cetera, is between you and the servicer, okay? When it comes to your employer, the only role that they will play and that you need them to play is what I'm about to talk about right here, which is how you apply for public service loan forgiveness. And that's through one form and one form only called the employment certification form. This form gets signed off by you, the borrower, and then it needs to get signed off by your employer, any current or previous employers you might have had. So let's say I currently work for a qualifying employer and I've worked for 2 previous qualifying employers that I'm looking to get qualifying credits for. That means I will need to submit 3 of these forms, 1 for my current and 2 for the previous, usually to someone in HR who has access to employment records that will basically sign off on the employer's eligibility, your start date, end date, and the fact that you worked 30 hours or more, and they will sign off on that form. And that form then gets submitted to the Department of Education directly. They review that form and they line it up. They basically look at your employment record, right? That time, those months, and then they look at your qualifying payments, right? Then they look at your qualifying loans, okay, right? And this is why it takes quite a bit of time for these forms to get reviewed and for borrowers to see their credits updated onto their federal student aid account. Because all of those things have to be lined up. Okay, that means, Lindsay, you have 80 PSLF qualifying credits as of today. Now, borrowers can certainly wait until they think they've reached the 120 to submit all of these forms for the first time. You don't need to submit these every year. There's no deadline or requirement around that. However, I highly discourage anyone from waiting to submit this form, especially waiting until they think they've reached the end. Why? It will take probably upwards of 4 to 6 months for the servicers and Department of Education to review all of that repayment history and employment history and be able to award you those credits. Second, the likelihood that they make mistakes and don't get it right the first time around is upwards of 50%. I'm not kidding you. How many times borrowers submit these forms and the Department of Education comes back and says, congratulations, you have 10 credits, when we know at Savvy that they should actually have 80. This happens, like I said, probably 50% of the time. Now, when they don't have Savvy there to be an advocate and to be able to say, oh, no, that's not correct, many borrowers, see that and say, oh, I guess I have 10 credits. Or even worse, about half of all PSLF applications are outright rejected for clerical or administrative reasons. Not because that borrower is not eligible or that employer is not eligible, but I'm not kidding you here, the formatting of the date was incorrect, or the signature was typed and not ink written. These things have caused massive rejections, and it came out at the end of last year after a big sort of investigative report from the CFPB. The reason why we were seeing such a high rate of rejected applications was because part of MOHELA's contract included the fact that for every application received, they got a fee. So MOHELA was actually just outright rejecting applications, forcing borrowers to have to reapply to make more money. The interests of the servicers are not necessarily, and I would say not necessarily as being generous, aligned with the borrowers, okay? And that's, again, where we come in. So when we submit a form on your behalf, we know you're eligible. We know the information on there is correct. And so if any other outcome comes back from the borrower, we are able to help make sure that that's corrected. So these employment certification forms, right? You don't want to wait until the very end. You can submit them as soon as your first 12 months working for a qualifying employer. And then I recommend that every 12 months after that, so basically every year, you submit an updated employment certification form for that current employer. It'll list your same start date, but the date at which it was signed will be a new updated date, right? 12 months later. And that way, you'll submit that to the Department of Education. They've only got to go back 1 year of time, right? So it's a quicker review process. And you'll be able to see each of those 12 months added to your credit count, right? Inching your way closer and closer to the 120. That way, when you get to the 120, there's no question that you're there, right? There's no prolonged waiting. And it's far easier to recognize a mistake and for the servicers to correct that when they're looking at those smaller increments of time. So with Savvy, we submit these on a yearly basis again and make sure borrowers are tracking correctly. Okay, so I'm seeing a bunch of questions come through on save and whether those payments are counting and things like that. So I'm actually going to touch on that in this next slide. But first, there were just two questions I wanted to address related to PSLF eligibility specifically. So someone asked about 30 hours a week, right? This average of 30 hours a week, whether or not it has to be in real time or can you average? So let's say one week you work 20, the next week you work 40. So I'll say this, it actually entirely depends on how your employer wants to calculate it. Now, when Savvy in doing these forms for borrowers works with employers, we actually encourage they calculate it in a way that is most favorable to the borrower. So for example, if one week you work 10, but the other week you work 50, we're going to tell them, hey, on averaging that out, that's 30 plus, right? We're going to let this whole month count. Now, I know of employers who go week by week, and if there's 1 week in a month in which you were under 30, they don't sign off on that month. So when we have the opportunity to submit these forms and basically guide an employer on the best practices for how to sign off on them, we help inform them and say, you want to calculate it as an average that's going to be beneficial to your employee. So if you have a fluctuation in hours, again, you want to help your employee, and we try to help them calculate it in a way in which you will get them the maximum amount of credits. So the real answer is it honestly comes down to how your employer and that person in HR decides to sign off on it. It's totally up to their discretion. All right, there were a few more questions that came through. So one more question I'll address, and then we'll go on to policy. Was someone asked about if they forgave a bunch of loans under what's called TEPSLF, and whether it's too late to have loans forgiven under TEPSLF. So they did. TEPSLF stands for Temporary Expanded PSLF. And it was actually a specific set amount of funds, if you can believe it, actually under the Trump administration, that they put aside and what they called this TEPSLF, because when 2017 came around, so if the program started October 2007, 10 years later, October 2017, that was the first wave of borrowers, right, who started to apply in thinking that they were eligible. Now, the rules around the program in 2017 were very strict, okay? They've since changed. Under the Biden administration, we saw a lot of improvements. There was something called the limited waiver, in which borrowers were able to get credit for past periods of time. But all to say, in 2017, borrowers applied, not knowing any of these eligibility requirements, just thinking, I've been a school teacher for 10 years, I'm eligible, only to find they weren't on the right repayment plan, right? They maybe were on the standard plan or another plan like that. In acknowledgement of the fact that they were basically rejecting 99% of all these applications, so no one was qualifying because these technicalities were so rigorous, the Department of Ed and Administration set aside a limited fund to basically provide forgiveness for people who could qualify under this TEPSLF. And that was borrowers who had worked for a qualifying employer, been making monthly payments, but it was under a standard plan. It wasn't under an income-driven repayment plan. That TEPSLF program, that fund has expired. That's been used up, so it no longer exists. You still may see reference to it on the Department of Education website and or in statements that you might receive and letters from the Department of Education, because they have yet to update it and remove it from those documentation. So if you see any mention or reference of it, there's no qualifying under TEPSLF. That is no longer in existence, but it has yet to be updated or removed from those forms. All right, I'm going to keep chugging along here, and then we will get to more of these questions. But I think this next slide is going to really help answer some questions here. All right, so I want to talk through some of the most important policy updates that everyone should be aware of right now. And again, these are as of Thursday, May 29, and I would say not could be expected to change, are likely going to change. And one of the benefits of Savvy, and you're all going to be able to get access to this at the end, is we communicate to you on any and all of these important changes right into your inbox. So if something's happening that you need to know about or that's impacting you, you'll hear it from us. the noise and the news can be can be tough. There's headlines, articles left and right, forgiveness is gone, things like that that make it very difficult to determine what's actually happening and how this actually affects someone with student loans. So that's our job. So let's talk about the current state of these income-driven repayment plans. So when it comes to this SAVE plan, right, this was the newest income-driven repayment plan introduced by the Biden administration. This plan is still on hold. Borrowers who were enrolled in SAVE last July were placed into an administrative forbearance, okay, automatically. They didn't have control over it, where no payments are due and they are not accumulating interest. They are not supposed to be accumulating interest. However, for anyone in SAVE who is on that administrative forbearance, we have seen interest accumulate on several borrowers' accounts. This is as a result of servicer error. So if you are on SAVE and in that administrative forbearance, make sure you are keeping an eye on that account to make sure that that interest rate is 0%, because we have seen indication that mistakes are happening. Great, right? So all to say, borrowers already enrolled in SAVE, right, and on that administrative forbearance will remain in forbearance, okay, while the lawsuits are ongoing. There has yet to be a resolution on the SAVE plan as far as the legal system goes. So you can remain on SAVE and in that forbearance. I believe for most borrowers in SAVE right now, it shows their next monthly payment as due in August. That's what they've pretty much put as the temporary placeholder for when they'd hope to have this resolved by. But in the meantime, again, this administrative forbearance means you don't have a payment due and are not supposed to be accumulating interest. Or you can switch to another repayment plan to begin making payments again. So you can apply and submit an application for pay, IBR, or ICR. Now, one really important thing to keep in mind, and I saw some questions come through on this in the Q&A. These months in SAVE forbearance, okay, the administrative forbearance, do not count as qualifying credits towards public service loan forgiveness, okay? Unlike the COVID payment pause, those months did. So if you're on SAVE right now and you've been working towards PSLF, as of right now, those months, you're not getting those credits, okay? And this has been since last July or August when that pause went into place. However, you have the option to purchase retroactive credit, qualifying credit for those months in forbearance or deferment through something called PSLF buyback. This was introduced in the last year and is only eligible for someone who has reached their 120th qualifying month of employment. So you cannot initiate a PSLF buyback to get credit for these SAVE forbearance months until you've worked 10 years of qualifying employment or 120 qualifying months of employment certified by the Department of Education. So they're basically reserving it for people who have reached that qualification, and the only thing holding them back is the fact that these months they're not getting credit for, but they have to have 120 employment months in the bank and qualifying according to their student aid.gov account. Okay. And that, obviously each year, right, you're submitting those employment certification forms. That's how you get those qualifying credits. So essentially this PSLF buyback works like this. So let's say on the SAVE plan, you qualified for a $10 a month payment. Okay. And then we went into this administrative forbearance, right? You haven't made any payments since. And for the 6 months, you've been in this administrative forbearance, right? You're going to do this PSLF buyback when you reach your 120th month of employment. That'll mean you are going to buy back the credit for each of those months by paying what you would have normally paid each month on that plan. So it was $10 a month, right? $60 total, $10 for each one of those months. That's how a buyback would work. There is a specific process on the Department of Education website through which a borrower would initiate the PSLF buyback request. And those processes go through. These are also being reported as part of the Department of Education's sort of public data output. And they are extremely backlogged on these, even more so than income-driven repayment plans. However, you are able to submit these, and Savvy can help you to do this. Just be aware it is likely going to take upwards of 3, 4, potentially 5 more months for them to process these buyback requests. Those are probably the last thing that they're going to be trying to work their way through. First come income driven repayment, then PSLF applications, then the buybacks. So, but that option is a viable one and is available. Or, okay, you can choose to switch into another income driven repayment plan. And those are now open and available to enroll. However, again, keep in mind the application processing delays. So it could take you a couple of months before you can even get into that plan because of the fact that the processing has just recently resumed. So across the board, you're expecting delays. But when it comes to save, here's how I think about it. For many borrowers, the difference between what they would pay on save and another income-driven repayment plan is likely going to be double. The save plan was the most affordable income-driven repayment plan to date. It basically cut payments in half from the typical 10 to 20%. So for many borrowers who have been contemplating, well, do I stay on save? I'm not currently getting PSLF credit, but I can get that through PSLF buyback. Ultimately, in however many years I reach that 120, or do I switch into a different plan to start making payments now? Well, when they look at how much that payment amount would be on a different income-driven repayment plan, that will really help you determine what you can afford to do at this moment in time. But if you remain in the forbearance, that's okay, all right? Because again, you have this option of the PSLF buyback. So it's not like you are completely throwing these months out the window. You will be able to get them back to count as qualifying credits. All right, next up, let's talk about some of these executive orders. First, the executive order in March around the Department of Education. So as I'm sure many of you may remember, in March, President Trump signed an executive order to begin dismantling the Department of Education and shift key responsibilities to states. Now, first and foremost, so everyone is aware, fully dismantling the Department of Education requires an act of Congress. So he cannot do this simply through an executive order. However, he can instruct Secretary of Education Linda McMahon to take every step within the law to begin dismantling the Department of Education, while, and this part's important, while ensuring continued delivery of essential services. What are those essential services? Well, student loan management, income-driven repayment applications, and public service loan forgiveness. So despite the fact that in March, he signed this executive order to dismantle the Department of Education, about half of all Department of Education staff were then laid off. Currently, the Department of Education is still managing student loans and all of those application processing for PSLF, et cetera, with a reduced workforce and with a backlog of applications, just to give you a sense of what we're working with here, right? So again, we're going to emphasize this, expecting longer wait times, but also expecting reduced system reliability, meaning call and wait times into your servicer. You may try to access your studentaid.gov account and find it's down and you can't log in. This has happened several times in the last couple of months. Or you may find the portal that you normally log into isn't working or isn't there. This is what we mean by reduced system reliability. Even as these federal programs remain in place, all of the things that you tangibly interact with in order to manage your student loans are going to operate at very reduced capacity. And that's very frustrating to borrowers, especially now when there's so much uncertainty. And the fact that, and we'll talk about this in a second, the consequences of a missed payment are becoming more severe than they have been in 5 years. So, the stakes are higher, and yet the sort of support and the mechanisms by which borrowers can try to address this are not anywhere near what they should be or what they could be. So again, this is really where I see Savvy's playing a big role for many borrowers. It's about being a source of expertise, but also when and if things are changing, you're getting a letter from your servicer that you don't understand, you can't get a hold of anyone to figure something out, and your payment is due in 2 days. Who do you call, right? Who can help you figure this out? That's where we will really come in. That's sort of our role right now. Over the years, we've had to play different roles based on what's going on, right? During the payment pause, no one had to think about their student loans. But now, we really need to make sure that we're protecting borrowers from those bad outcomes. Next up, another executive order, also from March, this one related to public service loan forgiveness. So in March, he signed an executive order attempting, and this is key, attempting to alter public service loan forgiveness employer eligibility criteria. He cannot do that through an executive order. So Linda McMahon, the secretary, was tasked with drafting new regulations to redefine the definition of public service. Mainly, the goal here was to exclude organizations that they said are aiding and abetting violations of immigration law, supporting terrorism, contributing to gender affirming care, engaging in a pattern of violating state laws, and so on. Now, just to be clear, when it comes to public service loan forgiveness, the eligibility terms for PSLF, the program itself, were set by Congress and written into law, unlike the SAVE plan, okay? That can go away in a heartbeat and will likely go away in a heartbeat. PSLF was written into law in 2007. So under the Constitution, they can't be substantially changed. And it would require an act of Congress to make any of those changes, right? So any changes can only be done through Congress, amendment, or a new law. Okay, so President Trump cannot alter those rules governing PSLF with just an executive order. But what he did do is he said to Linda McMahon, the Department of Ed, I want you guys to begin drafting new regulations. And so they have already initiated this process through something called negotiated rulemaking. This is a long and protracted way of basically going through the motions. They did this under the Biden administration to try and develop new programs or change programs through regulations versus changes in laws. I was actually privileged enough to be able to go 2 weeks ago, speak in front of the Department of Education and give 3 minutes of testimony defending the public service loan forgiveness program and why it is so important to so many 12 million public servants across the country. That was during the public comment period, which is now ended. And now they are going to form a committee that will review all those public comments and then produce in the next couple of months their draft regulations. This is a long, protracted process. We probably won't see anything until the end of the year. But all to say, PSLF is generally a bipartisan program. And again, the fact that it was passed by Congress protects it. It is also mentioned in your master promissory note. This is the legal document that you sign when taking out the loan. And so many of the lawsuits that are going against the Department of Education right now in the Trump administration are basically arguing that a program like public service loan forgiveness was legally afforded to you when taking out the loan, and therefore it must remain in place if you are paying back that loan. And that's why PSLF, out of all of the programs in existence, even other income-driven repayment plans, is the safest, okay, for those reasons, as in, it is not going anywhere. And so because of that, and I know many borrowers sort of the idea of forgiveness is easy to confuse, but for all of you on this call who are eligible, I really want you to submit those forms as soon as possible. All right. Get that employment certified, get that process started. But PSLF is absolutely not going anywhere. You're more likely to see a complete change of income-driven repayment plans altogether that before anything could potentially happen to public service loan forgiveness. All right, last on the policy updates here, and this is probably the most important because this is having a tangible impact right here and right now. And Bruce mentioned this a bit at the beginning of the presentation. The impact of late and missed payments. So at the beginning of this year, okay, for the first time, if you missed your payment or were late on your payment, you could incur the following penalties. So your credit score could be impacted. Missed payments started to be reported to the credit bureaus. Even one missed payment can be reported. which potentially could lower your score. After 3 consecutive missed payments, you fall into what's called delinquency. This is a actual official status that if you were to look at your studentaid.gov account, if you were in delinquency, it would mean you had missed 3 consecutive payments. If you miss 9 consecutive monthly payments, you go into default. Okay. So you have between the 3 mark, right, and the 8 mark of missed payments where you're in delinquency. But when you miss the 9th, you go right into default. And again, that's sort of an official listed status. And once you go into that default status, it can trigger what are called involuntary collections. And we're going to talk about those in a bit more in just a second, which can include things like wage garnishment, 15% of every paycheck. Your tax refund will get garnished or taken. It's called tax offset. And your Social Security could also be garnished. Okay. You also, upon default, lose access to any federal loan benefits. You can't take out additional student loans, receive financial aid, etc. You can't apply for public service loan forgiveness or an income-driven repayment plan. All of those things are off the table until your loan is brought back into good standing. Okay. Now, more recently, I should say this though, the reason, so things started back up in January of 2025. So during the COVID payment pause, March 2020, right, things started. That's when every federal student loan borrower payments were paused, interest waived, okay? So that was March 2020. That went through, okay, October of 2023. October 2023 is when payments were officially supposed to resume, and they did officially resume. However, under the Biden administration, when payments resumed, acknowledging that after 3+ years of pause, right, they were worried about people getting back into repayment, what that means for their finances. So they instituted something called a sort of a safety net, right, where during that period of time, so from October 2023 to October 2024, if you missed a payment, were late with a payment, et cetera, you would not incur the same penalties that you normally would. Unfortunately, what happened is because of the fact that no one could fall into delinquency or default for that period of time, okay, borrowers continued to not make payments. And many people didn't even know the difference between when payments ended and when payments resumed. So now we come here to October 2024, okay, that safety net period has ended. And it wasn't until January 2025 that the servicers actually started reporting those missed payments to the credit bureaus. So in total, it's been about 5 years since borrowers have experienced these consequences or faced these consequences around their federal student loans. Significant pause, all right, during that time. Now, a couple of weeks ago, the Department of Education announced that they were going to resume collections on defaulted federal student loans. Okay. And again, these collections had been paused since March of 2020, right, when COVID went into effect. Now, this was a serious change in announcement that would put millions of borrowers at risk of what are called involuntary collections. Okay. And these methods include, as I mentioned, wage garnishment. So they will garnish up to 15% of every paycheck. They will withhold your tax refund, and they will garnish parts of your Social Security payments. Now, in announcing this, the Department of Education said they will begin notifying borrowers who are impacted by these collections, so those who are in a state of default, that they're in default, they can take these actions to get out of default, et cetera. And we have started to see evidence of that, since they made that announcement and even into and past May 5th. Now, the biggest thing when it comes to delinquency, default, missed payments, et cetera, right, is most borrowers don't exactly know where they stand. I can't tell you how many borrowers I talked to right after that big announcement from the Department of Ed that they were going to resume collections on May 5th. Borrowers who thought, oh my gosh, does that mean I have a payment due on May 5th? And these are borrowers who have been in good standing and making regular payments, right? I find that borrowers who are actually in default don't know they're in default. And borrowers who are not in default think that they might be in default, but they just haven't been making payments because they're on a forbearance or something like that, right? All to say, knowing what status your loans are in might seem straightforward to someone without student loans, but it's certainly not. So, first and foremost, where do you find out where you stand, right? What exactly, according to the Department of Ed, loan status you are in? Studentaid.gov. Log into your federal student aid account, and it will show you on that dashboard. Literally, it will say loan status in repayment, delinquent, default. Okay, and so that's where you will be able to see exactly where you stand. If you know you've fallen behind, okay, if your account is past due, all right, obviously trying to get enrolled in a more affordable income driven repayment plan, right? Let's say maybe you were on the standard plan before that could help lower that monthly payment and get you returned back into good standing is going to be one of the most important first steps. And with Savvy, you can obviously explore your IDR options or eligibility, and we can submit those forms directly and right away to get you on track ASAP. But here's one thing I want to make sure everyone is aware of on this call. And again, this is sort of one of those tips of the trade, but I would say 99% of student loan borrowers don't know this. If you log into your Mohila or servicing account, whatever it may be, and you are past due, meaning it's showing in red, past due amount of, and oftentimes it could be thousands of dollars. Let's say you're past due $5,000. Now, most borrowers are sitting there thinking maybe they've missed two, maybe 3 more payments, right? Most borrowers, myself included, are sitting there thinking, I can't afford to pay $5,000 to bring myself current. There's no way. I mean, if I pay $50, I'm still going to be past due. So they see that past due amount get bigger and bigger, right? As those payments get missed. And they think they have no options because they can't afford to pay it all. Let me give you the key here. Borrowers are able to bring their account current without having to pay the past due amount by calling their servicer and requesting to use a forbearance to bring their account current. If they call and they simply say, I'd like to request a forbearance to bring my account current, the servicer will process that, bring the account current, and the borrower will not have to pay that past due amount. I can't tell you how many people this changes their lives. They go from thinking they were going to have to come up with $10,000 and sell things, et cetera, to pay this past due amount to even, get into good standing, to nope, with one phone call, we've taken care of that. Now we can enroll you in an income-driven repayment plan. Probably one of the most valuable tips you can give anyone. I know so many people are seeing past due amounts. They've missed a payment here or there, et cetera. When they log into their accounts, you can request a forbearance to bring your account current. That's all you need to say. Make sure that they do that. It takes about a minute on the phone once you wait those couple of hours to get through to someone, and they will read you some terms and conditions, and your account will be current as of that call. And then from there, you can enroll in a repayment plan that's affordable, and we can help you to do that. But I kind of want to just give a sense of what the result of all of these, whether it's, credit reporting, delinquencies, default, all of this kind of coming crashing down at once. So just within the last couple of weeks, the New York Federal Reserve came out with a report, and this was very sobering, that as a result of these recent actions, credit scores dipped by more than 100 points for 2.2 million delinquent student loan borrowers. Those are those people that are past due that I was just referencing. And since, for the first 3 months of 2025, more than 1 million borrowers had their scores lowered by more than 150 points. This is the kind of credit score drop that usually occurs when someone files for personal bankruptcy. That's how major, life-altering, severe we're talking about, okay? And about 2.4 million of those borrowers previously had favorable credit scores, and they would have qualified for car loans, for mortgages, credit cards before these delinquencies were reported. Unfortunately, only about 38% of borrowers are technically in repayment and current on their student loans. Okay. And so the Department of Education, when announcing that they were going to resume collections, also estimated that in a few months, about 10 million borrowers would likely go into default. when it comes to going into default and getting out of default, the process of loan rehabilitation, okay, is a 9-month process during which if someone's wages are being garnished, that garnishment continues up until the point in which those loans are brought back into good standing. There are generally two ways to get out of default, either by consolidation. So you can consolidate your loan to sort of get out of jail free card and quickly bring your loan back into good standing. Or you can go through the lengthy process of loan rehabilitation, where you have to agree to make 9 on-time monthly payments towards that loan that are determined by an agreement between you and the Department of Education's debt resolution group, at which point your loans can go back into good standing, okay? You can only do both of those one time. So if you've already consolidated your loans, you can't consolidate to get out of default. If you've already gone into default, rehabilitated that loan, and then go into default again, you can't rehabilitate it again, okay? So when borrowers come through that are in default, we help them determine which one might be better, which they can actually do based on their situation. But if it comes to the worst case scenario, which to me is wage garnishment, I have worked with probably a dozen plus people who have been in wage garnishment over the last, before the payment pause and now recently. And unfortunately, it got to the point, so it is so intensive to try to get out. These people had to quit their jobs because they could not afford to work there. They had to go get a cash job somewhere else. This is how life-altering and severe something like, and it's nearly impossible to get out of purely because of all of the administrative hurdles they make you jump through. They make you go to an in-person court hearing in only 3 cities in the country in which you must pay for your own expenses. They make it ridiculously hard for borrowers to undo that our primary concern and goal right now at Savvy is making sure we can prevent borrowers from reaching that point. And that's where I think all of you can come in and helping borrowers, almost like intervening right before we can get to that situation, is going to be the best way to help anyone that you think might be at risk of default, right? If we can intervene as soon as possible to get them back in good standing. And again, if they are past due, right, we can use that forbearance to quickly bring their account current. Let's not wait another day and another month of that negative reporting. But obviously, we're going to start to see this will have a trickle effect across the entire economy, consumer spending, et cetera, as more and more people fall into delinquency and ultimately default. All right, I know we're going to take a quick pulse check here, but I'm just going to take a quick peek at the Q&A. Ellie, feel free to chime in if there's anything you think you want me to answer now. Otherwise, I can keep rolling along and then just get to most of these at the very end. We don't have too much left to go on the slides.
Yeah, one question, is NSLDS still a resource? Oh, you said that you'd like to answer this question live. I see that.
I did. So NSLDS is the exact name of the file, what's called your student aid data file that you would download from the Department of Education, your studentaid.gov account. This is pretty much, it's downloads as a long text file, excuse me. It's almost indecipherable. And it's basically the official record of any and all federal loans that you have and all of the points of and all the different loan statuses, payment history, et cetera. It tends to be, behind what your servicer will be reporting. Your servicer, Mohila, is the one that's reporting to the credit bureaus. The NSLDS files and that information only gets updated every 3 months. But otherwise, yes, it is a resource as far as it is the official record. So having that in your possession, but you're not going to really be able to read it. But what I'll show you about the Savvy tool is we actually have a function where you can upload that file and we decipher it for you and pull out all the information we need to be able to determine what's going on. So you can sort of, plug that mess right in there and leave it to us to cipher it.
And then there's a bunch of questions about credit reports, Lindsay, that I think you can probably just answer. So, they're wondering about why does it only show up late after 90 days rather than kind of showing up at 30 and 60? And can you see who your servicer is on your credit report like that?
Yeah. So it's funny. We've seen so much discrepancy, especially because of the fact that servicers have not been reporting to the bureaus in 5 years. And we saw issues even with them reporting sometimes during the COVID payment pause. What were supposed to be counted as on-time payments were not, et cetera. So we've all to say we've seen discrepancies across the board here. But when it comes to reporting after 90 days, so it's on a 90-day cycle that the servicers report to the credit bureaus. That's why it'll only show up after those 3 months. As far as being able to determine your servicer through your credit report, I would not do that to determine your servicer. If you have federal loans, or you don't know if you have federal loans, but you should be able to create or log into that studentaid.gov account, that's where it will show you your servicer. If you think you have private loans and are not sure, private loans will show up on your credit report. But a servicer, it likely might show up as just the Department of Education when it pulls through. I've seen variations. Sometimes it says the Department of Ed, sometimes it says Mohila Department of Ed, but I wouldn't rely on your credit report to determine what your servicer is. That you should do through studentaid.gov. And the last one I saw here too about, when you call the servicer to request forbearance, how long does it take to talk with someone? So it's taking, I mean, depending upon your servicer, but Mohila, generally a couple of hours to get a hold of a human to be able to do this. Savvy can help you to do this. We can submit a forbearance request. There is actually a form that can be digitally submitted. So we can send that in on your behalf. But as far as getting to a hold of an actual agent, that'll vary, but it's taking longer and longer. So you're going to have to, figure out whatever the call times are and just try to get a hold of someone. But once you do, you say those words, and those are the magic words. And then bringing you into good standing happens instantly. And you'll see your account online updated within 24 hours. All right, with that said, I see a lot of questions about Savvy and how we can help, et cetera. So I think it's perfect timing for me to transition into exactly how we can do that. So I know that this has been a lot of information. I mean, more information than most people should normally be subjected to. So give yourselves a pat on the back for lasting this long. It's overwhelming, on good days, right? But just given everything that's going on and the uncertainty and the changes, and especially now that the delinquencies are being reported and borrowers are facing those consequences in a way they have not in 5+ years, borrowers are faced with more overwhelm than ever before. Just outside of the fact that there are different repayment plans and what do they qualify for, et cetera, right? The normal things that any borrower might face. So oftentimes you'll leave something like this with more questions than answers. And I can totally understand if that's the case, but that's really where Savvy comes in. We are designed to basically provide a personalized repayment and forgiveness plan for you based on some simple information that we ask of you. You can kind of think of it like a TurboTax for your student loans. We'll ask you some basic questions around your income, your family size. All of these, you don't need to look up information. You can generally answer off the top of your head. The process takes less than 10 minutes, and we're able to show you what you'd likely be eligible for, what that PSLF forgiveness in progress looks like. And so this is what we are going to be able to help, illuminate for you as far as your eligibility. However, that's only half of the game, right? Great. It's great that we can tell you what programs you're eligible for, but the real hurdles then exist, and the challenges start in actually navigating through those and enrolling and getting into them and working with the servicer, right? All of those steps in which things are going wrong these days. And that's where Savvy comes in and takes on the administrative burden. And if you upgrade to our premium level of services, which I'll talk about in a second, we handle all of that administrative burden for you. Income-driven repayment applications, public service loan forgiveness, you have to send it out to 10 different employers in your past. We handle the whole thing start to finish. We send it off to the HR at those various employers, acquire the signatures, submit it on your behalf. Teacher loan forgiveness applications, applications for forbearance, consolidation, loan rehabilitation, wherever you may be, whatever you might need, we're going to do that for you and submit it on your behalf. And then we're going to monitor it with you to ensure it achieves the desired outcome. Can't tell you how many people submit applications for these programs on their own and never end up making it into the program, or their servicer miscalculates their monthly payment, which happened for about 3 million borrowers when payments resumed. So said that they owe $300 a month when they should have owed 50. A borrower doesn't know that the servicer is making a mistake. Again, we monitor all of that because we know what exactly that number should be to make sure that you're on the right track. And if there are issues or discrepancies, or along the way, you get an email from your servicer and it's starting to make you anxious, you're not sure what it means, you can bring it right to Savvy and we're going to be able to answer and address your concerns. And that's where personalized support one-on-one from student loan experts comes in. I trained this team personally since 2018. This is not some far off call center. These are people just like me, student loan borrowers themselves, who work day in and day out with all of our users. When you work with one of these experts, you work with that same expert the entire time. That is your dedicated person. So you'll communicate, whether it's via email, telephone, or phone chat, with that same person who knows your case intimately over years, months, however long it may take. And we try to use the technology to make things simple. All right. So it's not all technology. Goodness knows, I far prefer talking to a human than I do, a chatbot. And so we use technology to be able to collect the information, right, that we need to make those certain calculations and determinations. We have a database of all of the public service loan forgiveness and teacher loan forgiveness eligible employers in the country. So when you start typing in your employer name, it pops right up. We can add your eligibility, right? We make that part easy, okay? And then we use our human expertise to help you navigate all of those touch points along the way. So I'm just going to show you a few sort of screens and images to give you a look and feel of what a Savvy platform and account looks like. So this is your Savvy dashboard. When you log back in, this is the first thing that you'll see. And it's where you can track various applications, what you might need to do, etc. Now, when getting started with the Savvy process, again, I likened it to almost a TurboTax for your student loans, right? So we ask you some questions around your family size. What state do you live in? How many dependents, right? Your marital status, etc. Your income, okay? Certain questions, again, that you'd be able to answer off the top of your head, and estimates are fine. And then your employment. This one is really important in helping us determine your eligibility around forgiveness programs like PSLF. Or teacher loan forgiveness even. And we have 150 plus state forgiveness programs in our database as well. So based on your specific profession or even state, you may qualify for a state program, and we can determine that eligibility based on the information you provide. When it comes to adding your employment, I encourage you to add not just your current employer, but any previous employers you might have had, right? Because these programs are all retroactive. And then the last step on the process is syncing or linking your student loan accounts. You can do so through a technology we have called Spinwheel. This pulls from publicly available credit data by just entering your phone number, or you can upload that NSLDS student aid file, or you can enter the information in manually. All of this student loan information is kept secure. We do not sell any data or give that information away. It is purely for the purposes of being able to determine accurately exactly what you're going to be eligible for. For example, if you have a loan type, maybe one of those older FFEL loans that would require consolidation, when you sync your loans, if we detect a FFEL loan, we are going to flag, you'll see it pop up right there, and we're going to guide you through the next steps on consolidation. Because if you were to go and submit applications for those programs with a FFEL loan, you'd get rejected, right? So we're going to take the steps necessary to make sure you're eligible first. And then that's it. You reach the end here where you see the plan options page. And this is where we show you exactly what those best options could be. So you'll see here, this is someone who's eligible for pay, but they've got 4 more plans that they're also eligible for below. They see what their new monthly payment could be, what that total payment over time looks like, how long until they'd be eligible for forgiveness down to the year, and sometimes the month, and how much in forgiveness they'd be eligible to receive. You can expand below for more details. I don't have the image here, but we do a comparison of this income-driven repayment plan to the standard plan. So borrowers can see the different options and payoff horizons accordingly. If you're eligible for multiple income-driven repayment plans, you'll see those below as well. Now, it's at this point where the next steps are going to be submitting the applications, right, to get enrolled in these programs. And that is where our premium services come into play. Everything up until that point, creating a Savvy account, entering that information, seeing your best options, attending any and all of our educational workshops that I lead every week, getting your questions answered in the Q&A, anyone can create that for free under our DIY. It's at the point where we've got to start doing the heavy lifting and submitting those applications on your behalf, monitoring and managing all of that for you, and at which you get access to a dedicated student loan expert. That comes under our premium services. We offer 2 levels: Essential, which is our most popular, and then Pro. This is like a concierge level service. You can actually schedule in advance from your account, sit down appointments. They help walk through setting up your account for you, etc. But really, Essential has everything that you need as far as all the applications, regardless of where you are, and you get full personal support anytime, however many times you need to, for that entire year. And it's at a low yearly rate. For NHRC members, there is a big discount on Essential and Pro plans. And I will say, out of all of our partners, NHRC has the lowest yearly rate, I think, of any partner. Way to go, guys. So it's a nominal rate. I don't know. I'll let Ellie share the pricing on maybe on the chat, or Ellie, I'm happy to share it out loud here. But the rate or the difference in discount for NHRC members is significant compared to non-members. Non-members are also able to upgrade to Essential or Pro, but those members get a significant discount. And I'm just going to show you what that looks like when that premium plan is in place. So here you can see this is someone with 3 employment certification forms for 3 different employers. Simply with the click of a button, we create and pre-fill and digitize that form, and we send it off to each of these 3 employers to obtain those signatures. We've pre-filled all of the employer information from our system. And if there's issues with the employers signing off, we are the middleman and we handle it. So there's no printing out a form, driving an hour to try to chase down someone from HR, only to find out they've signed the form incorrectly, but you've already submitted it, and find out months later after it's rejected. We eliminate all of that human error. When we submit an application, we know it is accurate and correct. We digitally fax it through our system. So we're able to make sure that borrowers are getting these in quickly and accurately. And then on the right here, this is just an example of how we pre-fill and digitize the income-driven repayment plans. Again, you can do it from your phone. We have built a proprietary, almost like DocuSign system, where everything pulls up. You can attach your income documentation right there, electronically trace your signature, and then it's submitted. And then the best part, and I really can't emphasize this enough, just given all that's going on right now, is the application monitoring. Again, I would say for borrowers who submit applications to these programs on their own, the likelihood that they will not succeed purely because of not their own fault, but of servicer error, because of all of these application issues, they never end up getting into the programs. I mean, over 50%. So with the application monitoring, again, you can see this is someone here, 3 of those employment certification forms and their income-driven repayment application. And zoomed in, they can see exactly where they are in the process, what's been submitted on their behalf, what we might still need from them, what the estimated wait time from the servicers is, right? For each of these applications, and these change based on what we're seeing from month to month, we know that if we're submitting that application, if the borrower has not heard back from the servicer within 2 months, we are going to follow up with the servicer to make sure things are going according to plan. Now, that's something now that the borrower doesn't have to worry about. Savvy is going to be monitoring to make sure, right, that that application is processed correctly, quickly, and accurately. And last but not least, accessing our customer support team. Again, these are about 10 people who are sort of the variations of myself, who work day in and day out with all of our student loan borrowers. We've got an incredible help center. We put together all of that content on our own. And then you can contact support through an Essential account via messaging right in your Savvy account. We also have live chat. That is actual live chat. It is not with AI. Those are our experts in the office as we speak, who do live chat every day. So you're able to see that right from your account, or you can call our telephone line. And our wait time is, just looked at this, 2.5 seconds. So we try to make sure we get to your questions quickly. Okay, so we're wrapping things up here, and then I'll get to some of these questions. This is it. So what to do next? You can go ahead and scan that QR code, and I will also put the link to that QR code in the chat. Submit what I'm going to call your request to access the Savvy platform. It's basically, name, contact, name of your housing organization or company, and you have space to provide any other information, anything you want to let me know, and then someone from Savvy or NHRC is going to follow up with you on next steps. But this is just the quickest way to make sure that we can connect with all of you. I can tell you this. I'm on basically a webinar tour, not as long as this one, but every day, multiple times a day, I'm presenting to various communities of student loan borrowers, whether it's a local teacher union, or whether it's ARP seniors, whether it's an employer, et cetera. We craft presentations. We can host and set up educational sessions on the go. So if that's of interest, we're always willing to try to help spread the word. But we can also provide you with the means of helping all of your members of your community access Savvy, support and accounts, and especially during this time right now, making sure that anyone at risk of delinquency or default gets help. And I'll be hosting a big town hall next week that by requesting access, we'll make sure everyone has an invite for on more of this credit reporting stuff. So with that said, I know that was a long one. I will try to get to as many questions as we can. Ellie, if there are a couple that you want to point out to me, let me know. But I'll start going through these as quickly as I can here. But I hope to everyone that this was helpful. I know it was a lot. I'm shocked that so many of you are still on. So Ellie, feel free to I know we're almost at the hour. So if you want to say any
Yeah,
final,
the
happy to
one
stay
thing that
on.
I do want to just say out loud to everyone who's still on, uh, so we will get together with Lindsay. Our pricing structure that we've had with you previously, Lindsay, was just for you either want the free or you want the assistance. I don't think we've ever had the delineation between essential and premium, so we should have a conversation about that.
Okay.
But what'll happen when you all use this QR code to access the information that Lindsay just mentioned, then they'll connect with us and we will let them know who are members and who are not. And there's a different pricing structure if you're a member and if you're not a member of NHRC. The other thing that I just want to ask about, Lindsay, before we sign off is,
Yep.
well, two things. First of all, can we send you the unanswered questions and then we'll just send out the answered questions to our listserv, number one. And then number two, um, can is this a QR code and the link that you are putting into the chat, is that also accessible for non-housing counselors? Like, can they give this to their clients for them to utilize?
Yes. This is basically our sort of broad general intake. So in any capacity in which you are interested or want, this is the purposes are to be broad and for anyone. So I'm going to put this in the chat right here as well as the
And
link.
I'll say, everybody, if you refer your client and you are a member of NHRC, you'll want your client to somehow designate that when they go in and fill out this form so that we know and Savvy can let us know.
Yeah, there you'll see on sort of the last question is there anything else we need to know or something like that? That would be the space to just mention anything
Yes,
like that.
right. Because if you're a member organization, your clients can get the discount as well.
Ellie, don't we have a special link for members?
That's changed.
Oh, okay.
That's what this QR code is. This is the change, is the QR code. So sorry, that was kind of a last minute conversation that we had with Lindsay this week. So
No worries. While people are maybe scanning that, just saw a couple questions I can answer quickly. Someone asked, do they have clients who would like to contact customer service, get help filling out the application for them, et cetera? Does Savvy do that? Absolutely. That is exactly what we do.
and the way that you tell if you're a member organization is you reach out to Ebony and Ebony will let you know. And I'll put Ebony's email address in the chat. Ebony is the membership guru.
And for Travis, who's asking, doesn't appear that, the public can use Savvy. How as a housing counselor can I connect my clients with Savvy? Travis, just go ahead, submit, fill out that QR code, scan that, fill that out with your contact information, and we're going to follow up ASAP to get you all set up.
And we do not have this information on our website. We have membership information. If you go into join as a member, there is some information in there about our different discounts, but we don't have the specifics about Savvy. I will tell you, as Lindsay said, it is a significant discount.
That's the value of the fact that you guys have been we're one of our first and longest standing partners, right? So we've been supporting each other for so many years, so really excited to keep that going. And I hope this was helpful to all of you. I know it was a lot of information, but if in doubt or not sure what to do next, again, we try to make this sort of as get your contact info in. You can add any notes, and then we'll go through and follow up from there. Because we know some people have their own student loans, maybe they want to use it for their clients, et cetera. So we'll be working closely to get to that follow up.
So one last question very quickly I'm going to address. If you default on student loans, can that prevent access to FHA, VA, and USDA loans? And the answer to that is yes, because it will have an impact on your credit score. So it can impact your ability to access those programs. All right, I think, Lindsay, with that, I'm going to hand it over to Bruce to just kind of quickly wrap us up.
All right.
Thanks, Lindsay.
Thank you so much, Lindsay. That was a tour de force and very, very helpful. So thanks so much for doing this. We will lean on you again soon, but terrific that you were available to us. So just wanted to do a couple things. One is you'll get another notice. It's probably on the screen, but you'll certainly get by email about the upcoming webinars that we've got. These are all aimed at being useful tools for you to do your work, and please take advantage of all that. And on top of that, I will move us on quickly to just remind people that we've done a good plug on membership, and would love to have more organizations be members, as well as many of you are coming due for renewal. This is partly what keeps us going, and certainly what gives us the flexibility to be able to deliver. And in fact, the reason for NHRC is this idea that we are stronger together. You're doing great work out in the field. We are really working hard to capitalize on that, to bring a united voice on things that most of the industry agrees on, so that we're able to impact policy environment, the lending environment, the information flow of tools that housing counselors need. So please get your organization to join if you're not already, and we really appreciate that support. With that, big thanks. So there's the upcoming one. So CFPB, the Consumer Financial Protection Bureau, has had multiple lots of changes recently. So we'll give you the experts next week. Who are key people from the National Consumer Law Center and the National Housing Law Project, who are deep experts in what the changes are, but also how that impacts, especially on the kind of work that you do on counseling that you need to know about in terms of credit and the loss mitigation protections, things like that. The strengthening services through smarter fundraising is one counseling agency that's got a comprehensive approach to housing counseling funding and many interesting mechanisms for it. It's definitely food for thought and definitely worth your time. FHA loss mitigation update. Well, there are changes happening on the FHA side. I believe we have Steve Sharp coming in, the area expert on this. Be a deep dive, but very useful for people. And public and private innovation is from the business manager for NPHS in California, and they're doing lots of great work that it's really the social enterprise kind of model, but they've taken it to pretty innovative directions, so that this will be kind of a thinking big opportunity. So with that, keep an eye out for Ebony's email with